Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is John Mayer, Chief ETF Strategist at JPMorgan Asset Management. And we're talking about the market outlook, including the ETF market outlook, and how investors should be positioning their portfolios for 2026. John, welcome back. Great to have you with us today.
Thanks, Nina. It's great being on again.
So as we enter 2026, one of the biggest questions for investors is whether stocks can deliver a fourth consecutive year of double-digit returns. And this is something which is historically rare. And so far, major indexes have continued their rally into the new year, though we have seen some rotation. And stocks have largely shrugged off geopolitical developments, including developments in Venezuela. And in fact, as we are recording this on Friday, January 9th, major indexes are at or near their all-time highs. So with that backdrop, tell us about JP Morgan's market outlook for the year ahead.
Thanks, Nina. And 2025 was a great year. We had some pullbacks of April of last year, but the market moved past tariffs and had finished with a very good year. Now, in any given year, there are a lot of moving parts. We expect that to continue into 2026. Now, growth and inflation should rise early in 2026 due to the budget bill that was recently passed, then cool off later in the year as tariff and immigration policy filters through. We're expecting 2 to 3 rate cuts in line with market expectations. Fed easing is a bet that tariff-driven inflation will subside, and then long rates should remain range-bound with modest yield curve steepening. Fixed income, especially active fixed income, certainly will be attractive in this scenario. Now, the immigration slowdown is a bigger threat to growth than tariffs, we think. And we think that the labor force growth is more concerning than import price increases. Now, valuations tend to be fairly high, and earnings are high too. So that's good. And this is supported by strong fundamentals. Secular themes such as the broadening of the AI trade and deregulation in financials, we think should be prioritized and focused on in 2026. So overall, we are expecting 2026 to be a solid year for equities as well as fixed income.
So you mentioned Fed rate cuts, and we received the December jobs report this morning. And with the unemployment rate falling a bit more than expected, we have seen this morning that traders are now dialing back expectations for a rate cut at the Fed's meeting later this month. And as you also mentioned, we know that Fed rate cuts have been one of the key tailwinds for stocks, and they are expected to be the key tailwinds this year as well. Has today's report changed your expectations for Fed rate cuts this year?
No, we're still expecting that the Fed will cut between 2 and 3 times this year. We think that there likely to be some political pressure to cut, but the Fed's independence is obviously very important, and we expect the Fed to do what they believe is best for the economy overall. And I don't think one job report is going to change our view, and we expect that to continue going forward.
Okay, great. So we know that AI has been one of the biggest drivers of the stock market rally over the past 3 years or so. But more recently, there has been growing chatter about the possibility of an AI bubble. And investors are also becoming particularly concerned about the increased debt issuance by companies like Oracle and Meta platforms as well. So I have to ask you about your views on AI and technology, and how can investors capture the upside of the AI revolution while managing the risks of over-exuberance?
Sure. The AI trade has been on everyone's mind since ChatGPT was launched around 3 years ago. We're cautiously optimistic on tech and the AI story. CapEx continues to be very strong. And markets are certainly being driven by the top 10 names in the broad indexes. And the market at some point is going to expect a return from all of this CapEx. Now, we are seeing efficiencies taking place by the use of AI, but we also see the AI story broadening out. And we expect that to happen in 2026. This creates an attractive opportunity for active managers. Now, if the market has been concentrated in 10 names, there's a lot of adjacency for the AI trade in other sectors, in technology, communication services, consumer discretionary. Now, our fund, JTEK, JTEK, we believe is a strong way to capture the AI winners. There's been strong flows into this ETF, about $2 billion last year. It's a fund that's over $3 billion and continues to outperform its tech benchmark by about 6 percentage points. It's not fully tech. It's about 56% tech, but it also has communication services and consumer discretionary. And we believe that diversification is key with strong valuation propositions in other markets, in other sectors, excuse me. So I think that's a good way to play the AI story is through active management, because at some point, those top 10 names that has to diversify more broadly for the AI story to continue on.
So talking a little bit more about diversification and diversification out of the US, we know that many international markets performed really well last year. While the US markets did well, international markets performed even better. And in fact, the MSCI All Country World ex-US Index, that outperformed the US indexes by the widest margin since the global financial crisis in 2009. Now, we know that some of these markets, particularly markets like South Korea, Taiwan, and China, they benefited from AI-related demand. Others also attracted investors due to their valuations. And in addition, the dollar posted its worst year since 2017. So for US investors, that meant incremental returns from currency translation as well. Do you expect the dollar to continue to weaken and international markets to continue to outperform this year?
So it's a rare year when international markets significantly outperform the US market, as you pointed out. And what I think is going on is that international markets are benefiting from structural changes. The AI story is certainly playing into it. There's fiscal stimulus you're seeing in countries like Germany. There's shareholder-friendly policies that are occurring. So we expect this to continue. It doesn't just cut off because the calendar changes. So 2026, we are expecting a good year for international. It was a standout story in 2025. We expect it to be a story going forward into 2026. And this is a big reversal from after nearly a decade of underperformance relative to US stocks, as you also mentioned. And one of the key drivers has been the notable decline of the US dollars, which fell, close to 10% last year against a basket of developed market currencies. And this currency movement has made foreign investments more valuable for US investors and amplifying the gains from international equities. And so we expect a strong performance to continue, driven by those structural shifts and the narrowing gaps with the US.
Now, let's talk a little bit about fixed income. And JP Morgan offers some excellent actively managed fixed income ETFs. And we know that bonds performed well last year. And fixed income ETFs, including your ETFs, they saw strong inflows. And there is particularly a lot of interest in the belly of the curve, the intermediate segment, because we expect more rate cuts and there are rising concerns about inflation and fiscal deficits. So do you expect bonds to continue to do well in 2026? And are there any particular areas of the bond market that you like more?
So first of all, just talking about ETFs. specifically, fixed income ETFs really resonated with investors last year because investors were looking for diversification. They were looking to maintain or increase their yield where possible amidst a Fed that is reducing interest rates, so moving out of cash, moving a few steps out of cash to maintain their yield was very important to clients. And we saw that in the flows. Almost 40% of fixed income ETF flows last year were into active strategies. And the reason we believe the flows were so strong in active strategies is because if you think about a fixed income index, like the ag is missing half of the market. It's missing the securitized portion of the market. It's missing portions of the bond market that investors really want to be allocated to. And also, ETFs, in a sense, if you look at passive strategies, the fixed income basket really, in some ways, is quasi-active anyway, because you can't find the exact bond that's in the index. You have to find a bond that is representative of a bond that's in the index. So by having an active manager that can look for mispriced securities, leverage a big research platform, and utilize AI components to synthesize data, it's really helpful in finding those most well-priced bonds out there. Now, we have some very interesting strategies that saw significant flows. One fund is JBND, which is our core bond strategy. It has a yield to maturity of 4.5%, had over $4 billion in net flows last year. And this focuses on the belly of the curve. And we expect investors to continue investing in that area. And if you want to go one step out in terms of core bond plus, adding high yield to your exposure, JPIE, JPIE, which has a yield to maturity of 5.4%. Both of these portfolios have inclusion of the securitized portion of the market, which is about $3 trillion in size. And there's so many different opportunities in the securitized portion of the market that we excel at and we include in our portfolios. And also investors have been very focused on taxes. Thus, munis have done very well. JMUB, JMUB, which is the largest active ETF out there, net flows of over $4 billion last year, has a yield to maturity of 3.6 and a tax equivalent yield of approximately 5.7%. Also receiving a lot of interest. Investors are diversifying their exposure. Last year, bonds worked. We expect bonds to work going forward into 2026.
Excellent. Let's talk a little bit more about positioning portfolios for 2026. So you do like international markets, you do like bonds. Which are the areas of the market do you find most attractive?
Well, the great thing about ETFs, there's an ETF for most portions of the market, all portions of the market at this point. So we do believe that an allocation to international. We talked a little bit about international before. We have a fund called JIRE, JIRE. This is a research enhanced index. It was one of our best performing funds last year. It was up over 32%. And what this fund approaches regional, sector, and style neutral, focusing on stock selection rather than macro bets. So it's sector neutral, looking at individual companies, trying to find undervalued companies and taking that exposure. And it's done very well against its stated benchmark. It's called the JP Morgan International Research Enhanced Equity ETF. We also think exposure to bonds like JBOND, JBND, or JPIE, if you want to step a little further and have some exposure to high yield. We also think large cap growth makes a lot of sense in this environment as well. We saw the AI story play out in 2025, and we expect that to continue having benefits into 2026.
Very interesting. Now, let's talk about the ETF market and your outlook. 2025 was a blockbuster year for the ETF industry in terms of flows, new launches, and volumes. And you produced this excellent guide to ETFs. So tell us about your overall takeaways and give us an overview of the ETF market place in 2025.
Great. So I'll start with talking about the guide to ETFs. This is a program that we launched about 14 months ago. I joined JP Morgan a little under 2 years ago to launch this program, both in the US as well as Europe and APAC. Now, the concept of the guide is to provide education about the ETF marketplace. You'd be surprised how many folks don't know what an ETF is. ETFs are important. There's $13 trillion of assets in the US, $19 trillion globally. The end investor should know what an ETF is, just like they know what a mutual fund is. So this program is broken out into chapters talking about flows, equities, fixed income, active ETFs, how an ETF works, the mechanics of an ETF, how to best trade an ETF, looking at different themes, looking at different exposures, and providing information about the market in an agnostic way. So that's the purpose of the guide. Now, within the guide, we talk about what's going on in the marketplace. Now, 2025 was what our colleague at Bloomberg, Eric Balchunas, calls the Triple Crown. I prefer to call it a hat trick year. So we had more launches this year than any other year, about 1,000 new launches, 25% more than the previous year. We had record trading volumes and just really strong flows. Now, we also had about 83% of the launches last year were actively managed ETFs, which is what JP Morgan Asset Management focuses on, actively managed ETFs. And we expect that trend will continue. Now, some of the areas that we've seen a lot of issuance have been in single stock levered ETFs, which is not something that we do at JP Morgan, option overlay strategies, buffered strategies, things that we do at JP Morgan with funds like JPIE, JEPQ. We believe that we're the OG or the original gangster of the derivative income space. We have the largest actively managed ETF on the planet with JPIE. And we believe that investors are really focused on these type of strategies, given, if you look at over the past 20 years, whether it be the financial crisis, COVID, the really poor performance in 2022 of the market, investors are looking more for outcome-oriented strategies. And the derivative income space really fills that hole. And so you're seeing a proliferation of these type of strategies being launched into the marketplace. We also think active ETFs overall are and will continue to go mainstream. You're also seeing conversions, an acceleration of ETF conversions from mutual funds to ETFs. You'll hear more about ETF share class, ETFs as a share class of your mutual fund into 2026, as more than 30 firms have been approved to issue ETFs as a share class of their existing mutual funds, which will be another reason why the end investor really has to know what an ETF is. And just one last note, active strategies in the US are about $1.5 trillion out of the $13 trillion in the US of assets, of ETF assets, $2 trillion globally out of the $19 trillion. And I expect to see a lot more product innovation this year, both derivative income, fixed income, privates. And it's just a space that is proliferating, as you know.
Excellent stuff, John. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights.
Thank you. It's great being on.
That was John Mayer of JP Morgan. Now let's quickly recap the ETFs that we discussed. So he talked about JTEK, JTEK, and he noted that this holds not only companies classified in the information technology sector, but also other tech companies in communication services and consumer discretionary sectors as well. And I'm looking at the top holdings. This currently has NVIDIA, Google, Take-Two Interactive, and Snowflake as its top holdings. Now, another ETF that I like a lot for holding all technology-related companies, all leading tech innovators, and I've talked about it many times, is the ultra-popular QQQ, or the cheaper version QQQM, because you get exposure to all the leading tech innovators in one ETF. Now, he talked about many fixed income ETFs, and these are actively managed fixed income ETFs. We know that JP Morgan is a leader in active fixed income space. So he talked about JP Morgan Active Bond ETF. The ticker symbol is JBND. And if you're looking for attractive income, then JPIE, JPIE. For municipal bonds, JMUB, JMUB. We also discussed international markets, and he talked about the JP Morgan International Research Enhanced Equity ETF. The ticker symbol is JIRE. And this focuses on developed markets, has 208 holdings currently, with ASML, AstraZeneca, Siemens as its top holdings. Now, one of the most popular and cheapest international ETF that provides exposure to both developed and emerging markets is by Vanguard, VXUS. It is the Vanguard Total Stock ETF, charges just 5 basis points and is ultra popular with 121 billion in assets under management. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.